Warren Buffett famously says that trying to forecast markets is a fool's game, that there are so many variables that trying to understand all the dynamics of a market is trying to know the unknowable. We can only deal in probabilities. Throughout history, during periods of time when people's faith in the efficacy of their purchasing power in fiat-denominated instruments, particularly debt instruments, is challenged, gold has done well. There are a lot of things on the horizon which might challenge people's faith in the maintenance of their purchasing power in US dollar-denominated bonds. The most obvious is negative real interest rates. If you buy the US 10-year rate today, the US 10-year bond today, you're getting paid about 4 in a currency that the Congressional Budget Office says is depreciating by 9, which is to say your government guarantees that you will lose 5% compounded for 10 years. By the way, the first promise they've made me in my career that I believe they will keep. Why hasn't the market reacted to that? Because the US dollar, as pathetic as it is in an absolute sense, is wonderful in a relative sense. It's doing well against every other currency in the world. And there is also a group of investors whose outlook around the market is so bad that they believe that losing 5% in US 10-year treasuries beats losing 15 or 20% in markets.
Right.
When will that sentiment change? I don't know. I've had people say to me, Rick, how can you beat the gold horse? It's fallen by 50% in 2 years. To them, I say, arithmetically, a precept which is true, which has fallen by 50%, is precisely twice as attractive as it was before it fell. This is simple arithmetic. Too often in the near term, people confuse narrative with arithmetic. So from my own point of view, do I know when it's going to change? No. Do I think I could know when it's going to change? No. Do I care particularly about knowing the unknowable? No. What I do know is that the whole set of circumstances around gold is as attractive or more attractive than it's ever been. The only thing that has changed is that the price of entry, as represented by the GDX, has fallen by 50%, which is to say the opportunity is precisely arithmetically twice as attractive as it was before. The idea that people, when they go to buy physical products, let's say winter's coming, somebody goes to buy a winter coat. Do they shop for winter coats where the price of the winter coat has been up by 50%? Or do they shop for winter coats in places where the price of winter coats is at a 50% off sale? Obviously, if people were to buy investment assets the way they buy physical assets, they would be better investors. And I would suggest to you that gold is a desirable asset, just like a winter coat with winter approaching. The only difference is that it's on sale for 50% off. I actually feel sorry for people who don't understand that logic. Yeah, and in the discussion that you generously pointed up, which is to say the uranium discussion, I was in fact way early. I was 4 years early. But I was way early in a sector where prior to the bull market, there were 5 remaining juniors, and the worst performing of them were 22-1.
Yeah.
Now, in that circumstance, almost irrespective of the discount rate you charge, the rent that I received when I was right overcame that discount rate. Gold is a more interesting circumstance because one owns it for 2 reasons. One, to protect yourself from the excesses of the state, and the other to make money. I'm in the odd place with regards to gold where I own a reasonable bit. And paradoxically, unlike many of your listeners, I hope the price goes down. If the price of gold goes down, it means the world's in better shape than I'm afraid it's in. And that doesn't hurt my feelings at all. But more importantly, probably in the near term, if the price of gold were to rise to $2,300 or $2,400, I wouldn't sell any of my gold. If the price were to fall from $1,650 to $1,500, I'd buy a lot of gold. So I'm in the odd position where, although I have a reasonable inventory, I hope the market devalues my inventory so I can add to my stash. because I think ultimately, unfortunately, the price of gold will do quite well. I would have said that the relative bargains in the gold space existed among the biggest and the best issuers. What's happened very, very recently is that the microcaps in a risk-off trade have fallen out of bed. And many of those issuers forgot to come to market to raise money when they could. They played chicken with the market, and they have to come to market to raise money now. In the private placements that I'm able to do right now, I believe it's much more likely than not, that my median return will be an 18-month double, perhaps better. And I suspect that somewhere in that club of private placements that I'm doing right now, somewhere there, I'll get a 10-bagger. And so I have two different time frames in mind. The high-quality junior mining companies, there's probably 150 of them out of a 3,000 stock universe, exhibit so much quality at such ridiculous prices that my suspicion is that almost irrespective of the gold price in the next 18 months, I'm going to get a raft of doubles, simply out of a dead cat bounce, if nothing else, with the high-quality juniors. With the index as a whole, I'm willing to look 2 years out, 3 years out, 5 years out. Not that I like to do that. It's just that 49 years of investing in the space has told me that I have to condition myself to relevant, accessible timeframes. If I have a surprise with a 5-year time frame, it's almost inevitably a pleasant rather than unpleasant surprise. I'm of the school of thought that says that the Fed can probably get away with 1 or 2 more interest rate hikes. I'm also of the school of thought that the depth and liquidity of U.S. securities markets and our high interest rates relative to our competitors means that in the very near term, U.S. dollar strength continues. But I mean the very near term. The last point you made, which is the impact of higher interest rates on federal, state, and local budgets, is one that I think will bite us very, very soon. I think, too, that we are beginning to be conditioned by the big thinkers, the Elizabeth Warrens of the world, that we are destroying people's livelihood in a sort of quixotic attempt to tame a beast that hasn't scared anybody for 40 years, which is to say inflation. And so I do believe that there are political pressures around a Fed pivot. It's important to look at history. In 1975, you won't recall, as Fergus certainly won't, he probably wasn't born then, but we had come off 4 very good years in the gold market, where the gold price went from $35 an ounce to $200. 1975, the Fed started to fight inflation. They raised the interest rate, they did stuff like that. The gold price fell from $200 to $100 in 9 ugly months. And then the Fed lost its nerve. And when the Fed lost its nerve, when the Fed blinked, gold went on a romp from $100 to $850. The fact that they were going to was obvious in hindsight, but very few people have hindsight. Fast forward to the end of 2001, 2002. Same circumstance happened. Gold came up nicely off the bottoms in 2000. The Fed decided to raise interest rates. The U.S. did well. U.S. dollar did well against other currencies. Gold did very well against other currencies, but not the U.S. dollar. Then the Fed blinked. And when the Fed blinked, gold was off on a romp. My belief is that the math and the politics suggest that the Fed has to blink, but they don't have to blink this quarter.